Bitcoin and Ethereum have a pattern. Explosive runs, then reality checks. Bitcoin and Ethereum have a pattern. Explosive runs, then reality checks. Bitcoin and Ethereum have a pattern. Explosive runs, then reality checks. With 2026 on the horizon, the big question isn't moon or doom. It's, are the conditions lining up for a meaningful move? Let's break it down with data, cycles, and context. Let's break it down with data, cycles, and context. Let's break it down with data, cycles, and context. Bitcoin and Ethereum are still the two pillars of crypto. When they trend, the rest of the market follows. 2026 matters not because of guarantees, but because structural forces may converge. Supply, regulation, adoption, capital access. I'm watching those, not headlines. Here's the challenge. Volatility is still high, which keeps long-term capital cautious. That means pensions and endowments don't scale in easily. Regulation is evolving, US, EU, Asia, which creates friction for product design and custody. Macro matters too. Inflation trends, interest rates, and global debt levels set the tone for risk assets. If real yields are attractive and liquidity is tight, speculative exposure shrinks. And then there's the ongoing debate. Speculation versus real usage. Are people using blockchains for finance, payments, and compute, or mostly trading? Without context, long-term forecasting becomes guesswork, and guesswork is risky. Now the development. Bitcoin runs on a 4-year-ish rhythm because of halvings. Every halving reduces new supply issuance. Historically, the major rallies tended to materialize 12 to 24 months after the halving, not day one. Markets need time to digest supply constraints and capital flows. Ethereum changed its own supply dynamics by moving to proof of stake, slashing new issuance by over 90%. In some environments, ETH can even trend toward net neutral or deflationary issuance depending on fees and burns. Meanwhile, institutional rails keep expanding. Spot ETFs, futures ETFs improved custody, clearer accounting, and better compliance tooling. As these products mature, the barrier for big capital lowers. By 2026, price action could be responding less to hype and more to fundamentals. Constrained supply, measured adoption, and steady inflows. Here's the key insight. Instead of calling exact prices, focus on conditions. 1. Sustained institutional participation, persistent net inflows, and longer holding periods. 2. Stable regulatory frameworks, product teams, market makers, and treasuries to plan multi-year. 3. Continued on-chain usage, more active addresses, real revenue for protocols, and clear product-market fit in payments, stablecoins, tokenized assets, and decentralized finance. 4. Macro stability. Lower rate volatility, improving liquidity, and a friendlier environment for risk assets. If these align, 2026 is less likely to be a sudden spike and more likely to be a cycle expansion phase, higher lows, more orderly rallies, and deeper, stickier participation. That's the difference between a hype wave and market maturation. So what do I watch? ETF flow persistence, not day one headlines. Derivatives funding and basis for signs of overheating. On-chain fees and usage to separate real demand from noise. Stablecoin velocity and tokenized treasury growth, and policy milestones that reduce uncertainty for custody, staking, and tax. Bottom line, 2026 isn't promised to be a breakout year, but it could showcase a more grown-up market structure for BTC and ETH. Long-term trends matter more than short-term predictions. Keep your thesis clear, your risk defined, and your time horizon realistic. I'll keep tracking the data.